Welcome to How Do They Afford That, the podcast that peeks into the financial lives of everyday Australians. I'm Michael Thompson. I'm a writer and the co-host of the podcast Fear and Greed Business News. As always, I'm with Hannah Campbell, financial planner, founder of Sugar Mama TV, the financial literacy platform covering YouTube, podcasts, Instagram, threads, books, TikTok and more, keynote speeches, all of these kinds of things. Hello, Hannah.
Good morning. I always say I'm excited about our episode, but this one's really serious because I feel like right now there's this undercurrent of panic and anxiety and overwhelm.
You are
what's
right.
Going on with potentially interest rates.
Yeah, you are right, because everyone is worried about money right now, it seems. It doesn't feel like that's an overstatement to say that. And one of the big stresses is the potential for interest rates to rise when everyone had been expecting them to start coming back down, because all the talk up until now has been that the next move in interest rates will be down. And now, all of a sudden, there is the potential for another rate hike, maybe another 2 rate hikes. Who knows? So today, we are looking at home loans, what to do to help ease some of that pressure. And for that, we have called in a special guest. We are joined in the studio today by Adam McCabe from Blue Lantern Financial Services. He is the mortgage broker that Hannah talks about often because he just knows this space so well. Adam, welcome to How Do They Afford That?
Good morning, Michael, Hannah. Thanks for having me.
Thank you for coming in. It is a bit of a scary time at the moment. How much financial stress are Australians under at the moment?
It is a scary time. And look, the stress is significant, and it's something that we're talking about on a daily basis.
How much are people paying for home loans at the moment? I know it varies significantly kind of from bank to bank, from lender to lender, but kind of ballpark, what is the standard variable rate at the moment?
Look, the best rates are below 6%, but on average, I'd say most people that we see are around the 6.3, 6.4.
Okay,
which isn't too bad. If you're getting above 7, you're in trouble, because of anything above, where were we 2 years ago? 2%. To be talking about 6%, 7%, it's scary.
It is a massive jump up in not a very long period of time at all. Hannah, what are you seeing in terms of the financial stress then that has put people under?
It's very real. It's very confronting. So there's some recent studies that have just been released by NAB that financial stress is the highest it's ever been over the last 8 years. Lifeline have also reported that 1 in 4 Australians are struggling to get by on their current income. And then the University of Melbourne has said more than half the country are only just making ends meet. And I saw another statistic, I believe it was on the 60 Minutes Instagram account. It was something like 42% of Australians don't even have $2,000 in emergency money to handle something that could just happen out of the blue. So that is really frightening.
It is. When you think $2,000, if you look at the timing of when your rent or your mortgage might be due, that's not much.
No. And suddenly you can see why everyone has been kind of banking on rates coming back down and just going, okay, at least if we can just get through this period, the next move will be one that will bring a little bit of relief. How worried should we be about the potential for another rate hike?
Very. And you need to be, because you've got to protect your financial future.
Mm-hmm.
So if that's, cutting costs or, reducing your living expenses where possible, to free up some room for those rate increases, you should do it. You've got to be prepared and plan for the worst.
I take actually a little bit of a different approach to this.
Oh,
and
I actually suddenly feel like
I love Adam. Adam is my personal mortgage broker, and I've known Adam for 18 years, and he also looks after all of my clients. But
it feels like this has moved from a discussion to a
there.
debate. It is now a debate. Go on.
Positive Pollyanna over here. Borrowing doesn't actually do anything. It's like a rocking chair. It gives you something to do, but it doesn't actually get you moving whatsoever. So instead, use your energy to do something proactive. So go and have a look at what's the interest rate you're paying right now, and if an interest rate rise happens, how much is your mortgage repayment going to go up by? Then you can work out, all right, we're going to have to find an extra $200 per month or $300 per month. With that information, you can then go back to your budget, go and look at, how much money you got from the new tax cuts. what can you do to maybe do some brainstorming as to how you can potentially work smarter, not harder, and to potentially bring in some extra money. Instead of just drowning and wallowing in the problem and what may happen, and obviously it's quite likely it will happen, get ahead of the game and start thinking about what you can do to help reduce this stress as much as possible so that if it happens, you're okay. You've got a few things or a few cards up your sleeve to help you get by.
Okay, I like that, and I like the idea of being proactive, and I think that's actually what we are trying to do here today. It is kind of like, it's not so much worrying about it, it is more using it as a bit of a wake-up call to go, actually, things might still get a bit worse before they get any better. So, Adam, to you then, what should we actually be doing? For someone who is perhaps struggling, what are the options that they can take in terms of trying to improve their situation with their home loan?
First thing is speak to your lender, your bank, check in on what your interest rate is and what they can do to improve that for you. So be honest, tell them that you're aware of lower interest rates on the market and you'd like them to come to the party and give you something better in order to keep you.
And are they likely to kind of call you on that, kind of, and they say, oh, well, what have you seen elsewhere, and things like, because I would be very, very nervous going into a call like that they are going to kind of put me under pressure. But I suppose you can find something just by Googling, can't you?
Definitely, and I've spoken about this a number of times before. There's an element of bluff involved.
Yep.
But you need to be aware that all of these banks and lenders have staff within their bank, within that business, to take these phone calls.
Yeah.
So they're expecting them.
Yeah.
So if you're not making the phone call, you're doing yourself an injustice.
And you can, I like what you said there about just be honest as well.
Yeah.
And the thing is that banks, you can actually just describe your personal circumstances. They are not heartless.
No.
And particularly kind of when you are under pressure as well, if you are not going to be able to make your repayments, you tell them.
You need to.
Them,
you
because
need to.
there are requirements in place for a bank to actually stop and assess and see what they can do to help you.
So essentially there are two ways that this could go. Firstly, if you fail to make your payment on the due date,
yep,
and you're in default instantly. Alternatively, you contact your bank or lender prior to the payment being due and let them know that you need some financial assistance and you can get a repayment holiday.
And that would be an uncomfortable conversation to have, but it's certainly better than the alternative, because the alternative comes with a whole lot of consequences, doesn't it?
It does. Well, default interest rate, so, normally 3% straight away, higher than your actual rate.
Really? It just instantly
That's the default. It's in your loan contract, what your default rate would be, which is normally 3% higher.
So what's the process involved for people who are under severe financial stress right now and they want to apply for that, payment pause?
Look, hopefully you act before then. As I said, it's in your interest to opt for a small repayment holiday, even if it's for a month or 2 months. Just to help you get back above water. So that's an option. And then you can extend that for longer. But financial hardship, it's different with every lender, but every bank and lender would have a financial hardship line or centre. So you just need to call them on their 1300 number, let them know the situation, what's happening.
And or you can talk sooner rather than later.
Correct. Or you can talk to your broker who would help you. Mainly brokers would only help with giving you direction on the numbers to call and what options, etc.
Okay, so that is for people who are in really quite dire circumstances.
Yeah. If
we are taking kind of probably one step back from that, and that is just going, okay, things are getting tight. Things are, and especially if rates keep going up, then it is going to get a little bit kind of tricky, but it's not quite at that point of needing a repayment holiday or potentially defaulting on your loan. You talked about the potential, just the ability just to ring up and ask, hey, I'm seeing lower rates elsewhere. What can you do? What about refinancing or kind of going somewhere else altogether?
Yeah, well, another option is, if you've got a number of personal debts, credit card, personal loan, car loan,
mm-hmm.
Ideally we don't like to see those being absorbed into the mortgage because you're then amortizing that over a 25, 30-year term. But if it's a difference between putting food on the table and not, consolidate it. Maybe put it on a separate loan
mm-hmm.
facility on its own so that you can prioritise paying that one off as soon as possible. So absorbing all of those financial commitments into one, so into your mortgage. That would help ease the pressure. But speaking to your bank about lowering the interest rate, if all of that isn't going to work internally with your one lender, then look at refinancing.
And is this a conversation that you have with your mortgage broker?
Absolutely.
Who can kind of take you through those options and say, hey, this is how this might work.
Correct, because it's not always the best thing to do.
Yeah.
Refinancing. So we need to ensure that you're getting financial benefit for moving.
Yeah.
So, if I hear from people regularly now who want to look at refinancing and doing some debt consolidation or something, they say they want a better interest rate, and they're on a rate below 6%. I'm sorry,
you're not going to get
the grass isn't always greener.
Yeah.
So that, along with what are the fees and costs associated with changing lenders, because there are exit fees and entry fees. Not everyone charges entry fees, but there will always be exit fees. Normally a few $100s to maybe $1,000, depending on how many security properties you've got.
Mm-hmm.
But the general one is the discharge of mortgage, and it's the government discharge of mortgage fees. So they're all things to be considered before refinancing, plus your remaining loan term.
Yeah.
You don't want to be refinancing. Well, if it's the best thing to do to get you through the hard times and you need to extend your loan term a little bit, okay, but ideally not.
A mortgage broker does have your best interests at heart in terms of this, isn't it?
Because we're obligated to.
Yeah, and it's looking at your financial situation and going, okay, this is kind of where you want to get. Yeah. So it's not so dissimilar to the kind of
financial planner
Correct.
Who takes an overall view of kind of where you are at, where you're trying to get to, and it is not just about kind of a particular product. It is about trying to achieve the goals of the client.
Absolutely.
Okay.
Can I just put in there, positive Pollyanna here and creative Canna, but, for anyone who's struggling right now is sit down and brainstorm. Michael's looking at me as in, oh yeah, here we go.
There is healthy skepticism whenever you kind of just chime in with, let's brainstorm, because I have no idea what you're going to come up with.
My creative brainstorming has helped me build a $285,000 share portfolio. So stick that.
You know what? I reckon there is a limit on the number of times that you can kind of use that against me. I mean, admittedly, it is substantially larger than any kind of investment portfolio that I have, so you probably can keep using it until the end of days. But
okay, the reason why I'm saying this is I was talking to a couple of people the other weekend, and they were saying how tight things are and how concerned they are, and they were talking about things that they're doing. And one person in particular said they're actually putting the house out on Airbnb over the weekends, renting it out, and going and staying with friends for the weekend. And it's like, that is actually, obviously it's taxable, but that is a brilliant way to help come up with some quick cash to make sure you can stay on top of the budget. And then other people renting out spare bedrooms, or another person I spoke to actually on Instagram the other day, and that is renting out their parking spot to bring in some extra money. So, whilst you're in this like panic and anxiety and feeling completely overwhelmed, have a go at thinking about what you can potentially do in the meantime, whilst also obviously getting on the phone and speaking to your mortgage broker and speaking to your bank about, what's going on and the stress and pressures that you're under. You never know. You may actually, be a stroke of genius behind this and a blessing in disguise.
Look, there's a bunch of things. I actually agree with all of that. And I shouldn't have been so skeptical going into that.
Is that an apology?
No, it is not. It is an acknowledgement that I might have been a little too skeptical. But it is not an apology and never will be. All right, so we've established kind of how much stress people are under, and we've talked about refinancing, and we've talked about just trying to get a better loan just by going and talking to your bank. We might take a very quick break and come back and look at a few other aspects, kind of fixing a home loan, and also kind of and I'm wary to mention this one, but accessing your superannuation for financial hardship, which I know is a bit of it is a tough one, and it is kind of, that's a last resort, but it's an important one for us to be talking about. We'll take a quick break and get into those ones. Hannah, we're talking about interest rates because there is a lot of talk that rates could still rise before they start coming down, and there is a lot of pressure on households. The cost of living crisis has not gotten any easier over the last 18 months, and there's not a lot of money to go around. And so we are joined in the studio today by Adam McCabe from Blue Lantern Financial Services, the mortgage broker that kind of you do mention him a lot because he does know his stuff. And so far, I haven't been able to catch him out on anything.
He's really good.
I know,
That's why he's
really is. Yeah, kind of in awe. We talked about refinancing. We talked about ringing up your bank and asking for a better rate. What about fixing? Kind of, is it possible at this time to kind of fix your home loan if rates could still be going higher, or are they kind of too high to even consider that? You just wouldn't look at that as an option?
No, so it's definitely an option. And what many people aren't aware of is that it can often be a very, very simple and fast solution. Just depends on who you're with, which bank, and what their appetite is in terms of their fixed rate pricing.
Okay.
So at the moment, with the way that, inflation's proven to be really sticky and the potential for rate rises in the short term, which is disappointing, but reality, it could be a good option to look at maybe a 1-year fixed rate.
Yep.
I would say definitely not more than 2 years, in my opinion. We're seeing some 1-year fixed rates at 5.99%, which would be a great solution if you're on a higher variable rate. Just depends on who your lender is and what their fixed rates are. What we're seeing mostly is the major banks are a bit too high in their fixed rate markets at the moment. But some of the other lenders certainly have some good options, and depending on your variable rate, and if you're not able to refinance, for example, and they refuse to improve your variable rate, then maybe taking a 1-year fixed rate gives you some stability, certainty, and
it's a bit of an insurance policy almost against the potential for another rate rise or another couple of rate rises. And I suppose that the challenge there is how much do you read into all of the speculation out there? And the real problem is that no one knows. No one actually knows whether rates are going to go up because it is weighed up. There's a whole lot of different data and a whole lot of people, a whole lot of very, very smart people. And there has been this belief over a very long period of time that they would be starting to come down. And as you say, it is that inflation, is that sticky inflation that just kind of hangs around and is causing us now to be looking at another interest rate hike. There are some limitations, aren't there, though, Canna, in terms of kind of fixing your mortgage?
Yeah, you lose a lot of flexibility when you fix your home loan. So sometimes, as Adam mentioned, if you want to look at fixing maybe for 1 year, perhaps you look at fixing, a quarter of your loan or a third of your loan or half your loan. And of course, stating the obvious, you're going to miss out on any interest rate drops if they happen to happen, within 12 months.
So you don't have to, I suppose this is a bit of a no-brainer, you don't have to commit to doing the whole thing. You could just do a portion, which is where it really does become that insurance policy. Yeah.
And a lot of people don't realise that. They sort of think you've got to go all or nothing. You can get, not creative, but I'm using the word creative a lot today. But, this is why talking to a mortgage broker and having a good quality mortgage broker working with you, and hopefully Adam agrees with me, you would advise, I'm assuming.
You can look at a 70-30 split, which is common, or 50-50. They're the two percentages we see most common that, gives customers some, stability and flexibility with keeping that part variable.
And the other big limitation that I think there's a lot of, misunderstanding is about the extra repayments. So some people think that you can't make any extra repayments on a fixed loan, but that's not quite accurate. Each bank has a certain limit, which normally ranges traditionally from $10,000 to, say, $20,000, but it then resets each anniversary, doesn't it?
Correct. Yeah. And if there were, this is getting a bit complex, but the fixed interest adjustment or penalty if you paid more off would only be applicable if the rates had gone the reverse of your fix. So if the variable rate was lower and your fix was higher, then you want to be paying as much as you can above and beyond because you're not going to get a penalty.
Great advice.
All right, so that's fixing rates. And I suppose this is, again, a conversation with your mortgage broker, that these will all be things that will be covered. There will be kind of a general assessment of kind of where you're at and what kind of pressure you're under, and whether you can get a better deal with your current lender, whether it's better to move to another lender, or whether it's better to look at a fixed rate. These will all be things that will be discussed in that phone call with a mortgage broker.
Yeah, absolutely. All your preferences, cash flow surplus, things like that would dictate whether fixed rate's suitable or not. They're all discussed.
Now, interest rates aren't the only thing that are putting pressure on people in terms of their home and the cost of living at home. I know, Canna, you talked in the past about the fact that people don't tend to think about all of these other expenses associated with home ownership, and they just keep mounting.
I know. I feel like so many people are caught up in the, great Australian dream of owning your own home, but no one really talks about the cost of owning property. And, I have spoken to so many families that obviously the stress of, the rising cost of living and rising interest rates, but also the cost of holding onto property. All of a sudden they've gone from renting to being a homeowner, and all of a sudden they've got to go account into their budget for, strata, council rates, water rates, things that you never did pay when you were, renting. But then on top of that, the natural wear and tear. If a dishwasher breaks when you're renting, you call the, landlord or your property manager, and you don't have to pay $1,500 to get a new dishwasher. These sorts of things are catching people out by surprise because no one's really planning and taking that into consideration when it comes to the cost of owning your own place and living in it and having to think about all those things we need. And these are just the basic things. I'm not talking about putting a swimming pool in or another level on the house. These are just the everyday wear and tear that we all experience as just a natural part of life. That's also rattling people's cages when it comes to keeping their head above water at the moment.
Yeah, look, I couldn't agree more, Kenna. The maintenance and upkeep of property, particularly with, looking in Sydney over the last few years with the amount of rainfall, water repairs, it's constant. But before I came here this morning, I was talking to a client who'd mentioned, the amount of work that they're spending on their home.
And they're not improvements. They're not renovations. It's just fixing.
It's maintenance.
And dealing things. And it's something that, especially in the Sydney at the moment with all the rainfall, a lot of families are dealing with mold in their homes. So as a priority, as a matter of personal health and safety, they're having to spend all this money on getting it fixed and, plumbers and builders and, obviously removing mold and so forth.
Yeah. Can I ask you a fairly broad question? This kind of is getting back to who is getting hit hardest by interest rate rises, because interest rates are a fairly kind of blunt instrument, aren't they? That they are applied kind of across the board, but they're going to hurt some people a heck of a lot more than others. For instance, perhaps a retiree with plenty of money that they're living off from their super. They might own their own home outright. They are not going to be affected as much as, say, a young family who might have just bought their own home, and they might have bought it kind of 3 years ago when property prices were kind of sky high. There is going to be a disproportionate amount of pain in the community, isn't there?
Absolutely, and that's one of the biggest issues that the consumers have had, or mortgage holders have had with this. The interest rate, the cash rate is such a blunt instrument.
Yeah,
inflation is impacted by these demands or day-to-day living, which is fuel and electricity, and the cost of that is going up, which isn't a consumer issue. It's just a supply-demand issue.
Yeah.
So interest rates, it's a blunt instrument. It's affecting mortgage holders and small business.
Yeah.
But those with the smallest deposits, particularly if you're first home buyers, because you'll get less discounts when you've got a smaller deposit. So when your loan to value ratio is higher, the banks give you less discounts.
Oh, really?
So yeah, that's another segment that would be impacted more.
So if you've been in the market for a bit longer and you own a bigger kind of portion of your home, you are more likely to get a bigger discount.
The best threshold kicks in at 60%. So if you own 40% of your home or more,
really,
then below 60%, that's where the best threshold kicks in for the level of discounts that you'll be getting from your lender.
And that's kind of why it makes sense to talk to a mortgage broker, because that is that's a fascinating kind of insight that you wouldn't know, and you can kind of you can use that.
Yeah, and we do.
Yeah.
And we do that as an ongoing maintenance and reviews for our customers. If your property value's gone up, then we communicate that to the bank when we're asking for a discount, for an ongoing better discount. We say, hey, their loan to value position has improved significantly. So even though what you've got them on, you might consider was great at the time, but it's not anymore. And if you don't sharpen that up, then they'll move.
All right, what are we seeing as a multiple of income today when it comes to borrowing money to buy a property? I mean, I know if we go back, say 8, 9, 10 years ago, it was a maximum multiple of 5. I read somewhere like we're looking at maybe multiples of 8 today. Would you agree with that? Or
probably. Look, that was I started back in 2002, and that was the DSR, your debt servicing ratio. And
can I just ask what this means first in terms of the multiples of income? Is that how much you are borrowing as a percentage of kind of how much you earn per year?
Yeah. So if you earn, say, $100,000 a year and the multiple is 5, it means you could borrow $500,000. It's a very, I guess, it's an outdated way of just loosely calculating how much you could potentially borrow.
Okay. And what you are like allowed to, what they will entertain as a potential.
It's not compliant anymore. We as a broker, we have to be responsible and have a best interest duty. So with that, we need to have a comprehensive review of each of our clients' situations.
Yeah.
Go through a budget, their income and expenses, and then work out what they can borrow. Someone, a family earning $300,000, family income of $300K per year, could have kids in private school compared to another family on $250K per year that have no kids.
Yeah.
So it just doesn't stack up. We don't have any.
Again, it feels like a blunt instrument.
Yeah.
Kind of, it doesn't feel like it takes into account the enormous variations that might kind of come into those arrangements.
I just think it's a cheap way for probably some other brokers and lenders to have a conversation over the phone to say this is what you can borrow, and I just don't think it's responsible.
I like that. I like the fact that that again, it reinforces this idea that you actually have kind of a client's interests at heart. And the last thing anyone wants to see is somebody in trouble and overcommitting to something that they really just can't afford. And this is the time when it's going to actually hurt people.
Because the all you're doing is maybe encouraging that person from a very brief conversation that as a multiple of your income, you can borrow and buy for this. And then all it takes is for them to speak to one broker or bank and be told no. They'll go looking for it elsewhere to the point where they might end up paying 7.5% just to buy for that price. And they've got no idea what they've put themselves in.
Goodness me.
Wow.
Okay. Just a quick one, Adam, on investment properties. If you do own a second property, for instance, is it the same process of trying to reduce your rate? Can you kind of do that as an investor? Can you call up your bank and say, hey, I've got an investment property with you. Can you move on the rate? Or is there less wiggle room?
No, it's absolutely the same. In fact, some lenders, if you've got a blend of home loan debt and investment debt, they'd be more willing to give you more discounts on your rate because that's the type of customer they want. Or it could be that they've got a heavily weighted owner-occupied loan book and they're trying to build up their investment asset base as well. So, no, it's the same process.
And I suppose broad question, really, to kind of finish on, is it easier to do this yourself? And this, maybe I suspect I already know what the answer is going to be. Or is it easier to call up a mortgage broker and actually get some advice and some help with it?
Yeah, mortgage broker is definitely the way to go because the good ones keep doing it year on year, as we do. You can call your bank, and in some instances, we need to ask our clients to make a call as well, just to ram home how much you are considering leaving to get a discount. But the best way is through your broker.
And kind of one last one for you, and really we did mention this before as a last resort. What about if you are really in trouble? Can you access your superannuation?
Look, under severe financial hardship, you can apply to the trustee of your superannuation and speak to them. And it is sometimes granted, but under very, very limited circumstances. And an absolute maximum of $10,000 may be released if you're successful in your application. But you've also some sort of terms and conditions and sort of hoops of fire, you could call it, you've got to jump through to be able to qualify, such as, being on government income support as well. And at the end of the day, that money, that if you do manage to get some money out, it's going to be taxed. And it's only a small amount of money. It's going to maybe plug a hole for a month or two, but then you're back to square one again. So it's not really a great solution. It's something just to get you by for the next month or so, and something I definitely do not recommend. And this is something you should be doing as an absolute last resort. And speaking with a financial planner, getting financial counselling, and speaking to your bank about what options are available to you. And
remembering that the bank they do have requirements to help you to assess your situation and to go, okay, this customer is in trouble. We need to do something to help.
Exactly.
All right. Now, Adam, surprise, we need a savings tip or a savings hack from you. We've actually just kind of got all of this information and all of this knowledge from you, and we are very greedy. We want more. Do you have a savings tip for us?
Something that I did yesterday and do regularly. So my wife and I enjoy a glass of wine here and there.
Mm-hmm.
And, you know, with the cost of living going up, you notice it in every aspect of spending day to day. Wine has gone up significantly. We buy our wine, a lot of wine, through the Qantas frequent flyer program.
Really?
Yeah, 70% off quite regularly for mixed cases or types of wine that you like. So that's what we do. And don't use your points.
I was going to say, can you use points?
No. Oh, you can, sorry.
But not advisable.
I wouldn't, no. We used our points to book some flights to New Zealand recently, actually. So,
and we did a great episode once, Canna, with Steve Huey from I Fly Flat, just advising on how to maximize your points. And you and Steve would be very much aligned on this one, Adam, because he would shudder at the idea of using your points to buy wine when you can use them instead to upgrade to business, or to actually get kind of your classic rewards kind of flights to various places around the world. So it sounds like a smart move. So 50 to 70% off.
Yeah, regularly.
Wow.
Regularly.
And that suddenly brings it back into an affordable kind of range because, there's not a lot of money to go around at the moment.
No, absolutely.
All right. Thank you so much for coming in.
Pleasure. Thanks for having me.
That was Adam McCabe from Blue Lantern Financial Services. Canna, how good was that?
Oh, brilliant. Just such a sound words of wisdom, and I'm just really glad. I even learned a lot today.
You don't normally learn a lot when I'm talking to you?
No, never. I never learn.
That is savage. Where do we find you?
Best place to get in contact with me is Instagram at Sugar Mama TV or Canna Campbell Official.
And you can hear me every day with Sean Aylmer on Fear and Greed, Australia's best business podcast. Thank you for listening to How Do They Afford That? Remember to hit follow on the podcast, and the best thing you can do is to tell somebody else, or better yet, send them this episode. If you think it might be of some value to them, spread the word about How Do They Afford That? Thank you for your company. Join us again next week.